Hey, everybody. Hope everyone is doing well. I'm going to wait for a couple of comments on the audio. This is a different computer I'm using, so there should not be any audio issues. But if there is, please let me know. So on the daily chart, okay, people are saying the audio is good. Perfect. Daily chart, we've been in channel bars below the moving average, and that's a sign that the bears are growing in selling pressure. But the only problem for the Bears is they've got to really overcome all of this. And this is enough down that we'll probably get a second leg down, but we don't know if the second leg is going to be up here. If it goes here, it could go all the way up here, but probably a minor reversal, which means we'll need some form of lower high and maybe a higher high. We had that basically on the 5-minute chart. Type bull channel, but this was consecutive buy climaxes, and we had a downside breakout, probably a minor reversal, and at least some form of a rally before you get a second leg down. And that's what 69 and 71 were. We rallied, we pulled back, we rallied again, and the Bears got a second leg down. On the weekly chart, I think this is pretty interesting. The Bears are trying hard to get follow through on the weekly chart. And you can see over the past couple of days right here, overlap today. I think that it'll be really interesting to see how this week closes. Can the Bears, first off, can the Bears get a follow through bar selling? Can the Bears close below last week? I think there's going to be something disappointing about this week. And that will I think that is most likely and will probably bounce. But I do think last week is big enough that there's probably sellers above, and we're at least going to evolve into a trading range. We've been so far from the moving average for quite a while on the weekly chart that we're probably going to get closer to it. And that's in part why this happened right here. This is getting climactic. Let me blow up the chart a little bit. So we're starting to get climactic through here. We're rallying. We've been away from the moving average for, 10 bars, 12 bars, something like that. And the odds are we're going to get closer to the moving average. And right here, look where the moving average was, 43.50. And it's basically 250 points away from the move. We're at this bar, it was about 250 points away from the moving average. And because of that, that increased the odds that the market was going to have to get closer to the moving average. Other factors as well. We have the March 22nd low, which we reached right there. So this is an area where traders were getting trapped, and that led to a big bear bar on the next bar. So sideways most likely, but this is a warning and reminder that the bears are probably going to be disappointed, or that the bulls are becoming disappointed. And if the bulls are becoming disappointed, look to the left. Where are obvious targets? We have the February high. We have this small lower high on March 19th. This area is a reasonable target. So sellers above, scaling and higher, the odds are they're probably going to make money. On the monthly chart, this is the cash index, but overall, same thing. Strong bull bar looks great for the bears, but a lot of overlap, decent follow through bar, but you're getting in that zone. There were bulls that bought here probably April or March of 2022, and it's a big bull bar. Some bulls got trapped. They bought a higher low, or they bought a high one in this area where this red line is. They got trapped on the downside, but they knew 60% chance if they bought and scaled in lower, they'd probably make money. And the reality is probably higher probability than that. So these bulls were buying and they were averaging in lower. Some of them would be really quick to get out, like above this bar. They bought, they scaled in, they'd get out probably around break even. That's in part why we had this tail. But other traders would wait. And look where we are. We're testing back to that high one price level. If you're a bull and you bought anywhere in here, anywhere, and you scaled in, let me back up. If you're a bull and you trade station, I don't know why it does that whenever I click on the edge. But anyways, if you're a bull and you were buying in this channel, you're disappointed by that bar. Some bulls will get out break even right here. And look, it didn't allow them to get out break even. We sold off, we pulled back on the next bar, and we sold off again. So this bar, this is a pretty decent size sell off, and it'll probably get a second leg down. And there's the second leg. But now this channel down is tight where the first reversal up may fail. So as good of a bar as this was, it was probably going to be minor. And then we formed a second entry buy, buyers below, and then we've drifted up. But you can see, strong bar for the bulls, and what do you know? The bears are selling it. So as strong as last week was, obviously it was a buy climax. You had so many traders happy to sell up here, both bulls and bears. The close of this bar is 88.96, and the high of this bar is 84.92. So it's different than the Emini, obviously, but it represents the same thing. There were more traders selling on the close of this bar and selling the open of this bar than bulls buying. Why do I use the cash index for the monthly chart? I could use the E-mini, and in part of the reason for the cash index is I don't want to have to redraw the lines, but also the cash index it's the S&P 500. So for the most part, let me get a sip of water. Anyways, what I was saying is the cash index is a very important index for the US economy. And obviously, a lot of traders will pay attention to it. So anything that happens in the E-mini is going to happen on this same chart. And that's why you'll notice even on the E-mini, you'll see the large stocks, whether that's for Apple, for NASDAQ, or Tesla, or any of the big name companies, they will generally have the same patterns because they all make up the S&P. Let's go back to the 5-minute. On the 5-minute chart, I thought coming into today, we had consecutive buy climaxes, and I thought we would form a trading range on the open. If you read the blogs, I almost say pretty much every day with intention that there's an 80% chance on the open, if not higher than that probability, that the market will go sideways for the first 6 to 12 bars. So why do I say that? I say that because the odds are really high that if you just sit patiently on the open, you will probably, the market will be right back to where it was around bar 6 or bar 12. Here, this was different, but a lot of days do this. So what kind of open was this? This was a pretty much breakout mode open. You know, it's really common to get a brief sell off, maybe 1 or 2 bars, and then sideways for 12, 13 bars. I do not really consider this a trend from the open. You can call it that if you really want, but to me, we had a bear breakout and then we went sideways. So to me, I see this as a breakout mode pattern, and the market's deciding, are we going lower or higher? You can also call this a bull flag, a bear breakout below a bull flag. We had a bull channel here. It evolved into a trading range through here. In other words, I like to use boxes on pullbacks to kind of explain the evolution into a trading range. But anyways, we have a pullback and we're still going sideways. And then what do you notice about this breakout? It is trapping traders. And because of that, the odds are it's going to lead to lower prices. So let me go back to the first bar. First bar of the day, it's a doji, probably buyers below, and probably going to go sideways for the reasons I just stated. Bar 2 broke below 1, but probably buyers below. Is it always in short? No, it's the first close below the moving average since 39, and probably just going to lead to a sideways day more than probably going to lead to buyers below. If bar 3 is a big bear bar, then it'll probably be sell to close. But the reality is, even if bar 3 was a big bear bar, bar 1 will probably relieve the bulls who bought below it. And that's what happened on 3. Bulls bought the low of 1, they scaled in lower on 3, break even at their first entry. Bar 2, an inside bar. For the bulls, they see it as 2 legs down, bar 80 and bar 3. It's also nested in 2 smaller legs, bar 1 and bar 3. Breakout mode bar, probably going to go sideways. For the bears, if you are short, I think it's reasonable to get out above bar 4. What about selling above bar 4? There probably are sellers above bar 4, but with all the tails, we could easily go above a bar like bar 2 before the sellers come in. Bar 5, double top with 3, broke below 4. Probably buyers below 4 and buyers below 3 and more sideways trading. We're testing prior breakout points right here. 6, inside bar, second entry buy for the bulls, but a micro channel since 1. Probably sellers above. But when you look at this chart, you have 1 trend bar and 5 trading range bars. All of these bars are overlapping, and that's a reminder that this is a trading range day. Bar 7, bull breakout of the past 4 bars, but in a close above the past 3. Strong enough bar, probably at least a small second leg up. But the second leg, we may not get a second leg until we fall below bar 5 or 6. In other words, this is strong enough for higher prices, but we could easily fall below before we rally. And that's what happened on this bar 8. 8, big bear bar, a little bit of a surprise, possible double top with 3 and 7. But there's been buyers below bars and sellers above bars for the past several bars. So you look at a bar like 8, it's a mistake to think it's going to break to the downside. It might, and if it is going to break to the downside, there'll be plenty of time to sell. So there's really no rush to do anything. 9, an inside bar. For the bears, you can call it a form of a triangle. For the bulls, you can. What the bulls are trying to do here is they're trying to defend the breakout point above yesterday's 88.58, and they're trying to get an early low of the day. They see a 20 gap bar buy on 9 or 6. We've been above the moving average for a lot of bars. Now we're completely below it. Whenever you get bars completely below the moving average, it's usually a sign that the market's developing into trading range, and it might lead to a final flag in a major trend reversal, like a lower high major trend reversal or a higher high major trend reversal. 10, a doji, the bulls that bought above 9, disappointed on 10. If you're buying in a tight trading range like 9 and you see 10, a lot of traders will consider getting out around break even though 10 is not a bear bar, and you can argue that's good for the bulls. If you're taking a low probability buying in the middle of a tight trading range is a low probability buy. And if you're taking that kind of buy, you really want strong follow through on the next bar. And that's exactly what happened on 11. You can see the high of bar 9. If you bought above it, is 13.25. Your entry price would be 13.5. And you can see the high of this bar is 13.5. So bulls bought above it, and they were so disappointed by 10 that a lot of those traders, instead of getting out at their original entry, they just hit sell the market or close the trade. And they were willing to take a 1 tick loss or a 2 tick loss to get out of the trade. Now, when you look at 11, it's closing below 9 and 10. You know there's probably buyers below, and the market is probably going to fail to break out below 3 or 5. But it's a breakout mode pattern. So if you start to get consecutive bear bars, you'll have more and more bulls begin to give up. 12 reversed up. So the bulls that bought above 9 and more below 9 obviously made money with 12. The market's giving us really important information here. Stop order traders are not doing well at all, and limit order traders are doing very well. They're able to make a lot of scalps. If you're a limit order trader, you're in essence buying below 4, you're buying, above 6, above 5, you're buying below 7, buying below 6, you're selling above 9, buying below 11, selling above 12, and they're really quick trades. 1 point scalps, 6 tick scalps. They're really small. If this range, most traders shouldn't do it, especially with micros. And you can see they're selling above bars like 11 and 12 even. Now 13 is a triangle. We've had 3 pushes up, 3 pushes down, making this whole thing a triangle, which is a tight trading range. And that is a breakout mode pattern. We tried to break out on 12. The bulls, you can see that the bulls have had 3 decent buy signals, 6, 9, and 12. And they keep failing. If they keep failing to get a strong upside breakout, eventually the bears are going to take over. So when you see a bar like 13, tight trading range, and it's an endless pullback since the bar 1 or yesterday's bar 77, you always have to be aware of the possibility of a surprise breakout below 11 and the sell off. So bulls that bought above 12, I think it's reasonable to get out below 13 or at least have a stop below 11. As far as selling below 13, you have to assume if you do, it's a 50% trade. So 50% chance it breaks the downside, 50% chance it fails. There's also a 50% chance when you're in a triangle that you break below the triangle and reverse up and go the opposite way. Same thing for the upside, 50% chance you break out and reverse down. $14 outside up. So the bears who sold below 13 and put a stop above 13, obviously they got stopped out. And then you can see what happened on 15. So you had a lot of bears selling below 13 and selling more above 13. And they just, right here, some of them are getting out break even. And then 16, we have a bear bar closing on its low. So there were bears who sold below 13 and sold more above 13. And obviously, the market's trying to continue the sell off. Breakout mode, looks like the bears are going to try and get their breakout. One of the interesting things to notice over the past 7 bars, from bar 16 to about bar 9, is there's really only 2 closes above the moving average, which was 12 and 14. The rest of the bars, the majority of the bar was below the moving average. Even bars like 13 or 11 right here was completely below the moving average. And that's a sign of bearish strength. And that's a subtle sign that we may break to the downside. 17, surprise, bear bar, consecutive bear bars, 16 and 17, trapped bulls that bought below 15, 14, or 11, anywhere in there. Probably the first reversal up will fail. And we're near the 63 low. So that is a target, which is right here. So probably going to go at least a little bit lower. For the bears, reasonable to assume that they're going to get some kind of measured move down. 18, now we have 3 consecutive bear bars. Follow through after 17, probably sell the close. But you're right at the 63 low from yesterday. And there's probably buyers at that low and bears taking partial profits. But the first reversal up will probably fail. And then you can see 19, we have an inside bar. Probably sellers above 19, scaling in higher for at least a small second leg down. For the bulls, they see 19 as a possible second leg trap. And they're hopeful that bears get trapped selling above 19 and the market reverses back up. But I think more likely the bears are going to get a second leg down. 20, an inside bar, low one short after 17 and 18, but it's a low one short after a decent size breakout. So probably sellers, there might be buyers below. In other words, there might be some buyers buying below this bear bar right here. But even if there are, I suspect they're going to be pretty quick to exit. And whenever you get a strong breakout like this, there's a greater risk of a second leg down and a measured move. So you always have to be aware of the potential of low one traders, of the bulls buying below the low one, getting trapped. And that's exactly what happened on 21. 21, big enough surprise, probably going to go lower. Any of the bulls that bought below 19 and 20 are now trapped. Why do I keep talking about the bulls? Because in general, when you get a low one, typically there's sellers, there's buyers below. Just like when you get a high one, typically there's sellers above. You can see 36, high one buy, broke above it on 37, and we pulled back testing it. High one here, 45, broke above it, pulled back. This high one, 61, broke above it, pulled back. High one here, broke above it, pulled back. And that's very common, and it's the same with low ones. But 21 has the potential to trap those traders who bought below 19 and 20. Now, the one problem with buying 19 or 20 is we have a big open gap right here. All the bulls that bought below 11, where the red line is, they got trapped on 17, and that increases the risk of a second leg down. 22 consecutive bear bars. Are we always in short? We are, and it's a strong enough breakout. 21, 22, probably going to get at least a small second leg down. Obvious target below, which is the low of yesterday. But we have a tail on 20. Excuse me, we have a tail on 22, and that's a warning that we may start to go sideways fairly soon. 23, 24. Now we have 4 consecutive bear bars and then a small doji on 24. Whenever you get a sell to close market like 21, 20, and even this was sell to close, really all through here, 17, 18, all of that sell to close. If bulls got out above 19, they sell again below 20. But either way, any of the bears that were short, whenever they see 24, 24 is a doji in a sell to close market. And that's a warning that the market's probably going to start going sideways soon, and it may even pull back. So that means there might be more buyers below 24 than sellers. You can argue consecutive sell climaxes, sell climax on 3, sell climax down to 18. And then a third sell climax down to 23. 25 outside up, but first bull bar and the first close above a prior bar since bar 12. So obviously pretty strong sell-off. Consecutive sell climaxes though, and so consecutive sell climaxes on 18 and 23 may get a small second leg down. The one thing we know after 24 is the market's probably evolving into a trading range. And what that means is there's probably buyers below 25 scaling in lower. So whenever I see a bar like 25, it's not a great buy the close, but it's a warning that if you fall below 25, you're probably going to find buyers not far below. Tw- 26, a bear bar after 25. A lot of the bulls, if they bought the close at 25 hoping for a sharp reversal up, when they see 26, a lot of those bulls are going to bail out. And it's the opposite for the bears. You'll have some bears who see 25 as a bull bar, and rather than they'll see 25 and they know it's allowing them to sell at a premium, so sell at a better price. But the only problem is a lot of bears don't want to sell an outside up bar closing on its high. So instead of selling that close, they wait for bad follow through, which is what happened on this next bar right here, 26. And as soon as that bar closes, you have more bears selling the close on 27. 26 was a low one short. You can also argue it was a low two, but either way, You have bulls who bought below 26, trapped on 27, increases the odds we're going to go at least a little bit lower. And then 28, you can see the high of 28 and the low of 26. It formed a gap. Consecutive bear bars, 27 and 28. But again, remember what I said about bar 25. 25 probably put the market back in a trading range. Typically, in channels, your second and third legs are part of a trading range. So when you think back to Al and how he says 90% of bars, 90% of breakouts are within a trend, are within a channel or a trading range, and only 10% of breakouts are truly breaking out and are going to go far. That's this concept. When you look at 27 and 28, it is probably a breakout within a trading range. And even if we sell off for a measured move down of 25, which we pretty much did, the measured move down was about 44.78 down here. Even if we do get down here, this is probably going to evolve into a large trading range. 29, 3 consecutive bear bars breaking below yesterday's low, but a tail and a smaller body compared to 27 and 28. Possible sell vacuum down to yesterday's low. And with all the consecutive sell climaxes we had, low probability that we go that far below 24 or below, low probability that we fall a lot lower. So I suspect bears will start taking profits and aggressive bulls start buying. 30 tested the measured move down and reversed up. What about buying above 30? You can, based on consecutive sell climaxes. It's a parabolic wedge, 18, 20. But certainly, I would definitely get out of shorts above any bar. And as far as getting out of shorts above 25, I think that is okay as well. It's a big bar, probably a small second leg up likely. The only problem was it failed to trigger. So I'd get out of shorts above 30. 31, bull bar closing above 30, and it went above 29. Good for the bulls. Probably going to go at least a little bit higher and get closer to the moving average. 32, 3 consecutive bull bars, tail above 32, but probably buyers below 32, scaling in lower. And by the way, this whole concept of being far from the moving average, it's the same thing I talked about on the daily chart and weekly chart. Down here, I mentioned that the market was probably in a trading range. And if the market's probably in a developing trading range, even though you don't see the trading range yet, when that's the case, typically traders don't want to sell far from the average price. The moving average is a reflection of the fair price. And if the market is far away from it, you know that means traders are going to start taking profits. Traders want to sell closer to average. If you're selling cheap, far below the moving average, you're doing it because you expect the market to plunge. It's the same concept of buying far above the moving average. You're only doing it if the momentum is worth it. So if you're buying here far above the moving average, you can see what happened over the next few bars. You had less traders willing to buy up here far above average in the market, and the moving average had to get raised higher, which is why when the market went sideways, with the market going sideways, the average price gets closer to the current price, and that allows traders to be willing to buy. 33 inside bar, high one buy above 33, but probably buyers below 33. But there also is probably sellers above 33. Strong enough rally up to 32, probably buyers below for a second leg up, and we'll probably get above 25 or 26. 34, you can argue a failed breakout above the high one, 33, but that's the first bear bar in several bars and a pretty decent sized rally. So probably buyers below 34, scaling in lower. 35, bull bar, reversal up, probably buyers. You can see buyers below 33, buyers below 32, testing the breakout point of 30, but it probably a second leg up likely. As far as selling above this bar, I think it's kind of dangerous. It's a second entry buy after consecutive sell climaxes, and the odds are we're probably going to get some kind of leg one, leg two. So leg one, pullback, and leg two, which takes you up to this measured move target right here. 36 broke above 34 and 32 and pulled back. There's one thing that's very important that happened on 36 and 37. The bears that sold above 35 and scaled in on 36, whether or not they scaled in, you had a lot of bears who sold above 35 and were disappointed on 36. And because of that, when 36 closed as a weak sell signal bar, in other words, when it closed as a bull bar and there were probably buyers below, you had a lot of traders move, try to exit, break even. You had a lot of bears trying to buy back shorts at the high of 35. They sold the high, they scaled in, and they got trapped. And you can see the high of 35 is 90.25. Excuse me, it's 80.75. And the low of this bar are really not all that ideal. If you're buying above this bar, if you're buying above this bar at 88 even, and price goes your way and you move your stop to break even, you would get stopped out to the tick only to watch the market go higher. 37, possible bull breakout. It's possible second leg up and a failed breakout above 36 or 26. Good bar for the bulls. I suspect they really need a follow through bar, but we're probably always in long. But a trading range is more likely than an area to go long. But the one thing the bulls going for them is they've trapped traders who sold above 35. 38, bear bar. Bear bar, probably buyers below. For the bears, it's a second entry sell and two legs up. So it's a double top with 26 and two legs up with 34 and 37. But if you are, if you're selling here, you're selling after an open gap. $39, decent entry bar. Let me back up. 39, obviously, you have bulls who bought the close at 37, disappointed on 38. And that's why 39 looks the way it does. The market rallied on 39, trying to allow the bulls who bought the close at 37 to get out, and then it closed on its low. But again, there's trapped bears, and I think there's still probably buyers below 39 rather than sellers below 39. 40 outside up, a little bit of a surprise for the Bears. The Bears see a wedge with 32, 37, and 40. And the Bulls, they're hoping this is the start of a bull breakout above the bear flag. We have an open gap, the close of 33 and the close of 39. So, in other words, you can call this a thin area. But the point is, on a line chart, this gap didn't close. There's overlap between these bars. So, obviously, you could argue it's a negative gap. But the way I view gaps is the more difficult it is to exit a trade, or the more difficult it is to sell above a bar, scale in, and get out. In other words, you had one opportunity to exit shorts on 40. And if you only have one opportunity to exit shorts, in other words, one opportunity to buy in this green box when 40 went down and the market turned up, that increases the risk of traders giving up. 41, we have an inside bar. And by the way, sometimes I'm muting myself to get a sip of water or clear my throat for a minute. So that's partially why the audio is, I would assume, people are saying that it's interrupting. That's in part, I'm cutting off the mic at times. 40 outside up, but 41 an inside bar. For the Bears, it's second entry sell, but the rally from 30 is pretty tight. So there's probably buyers below scaling in lower. It's a 20 gap bar sell. So that's good for the bulls and a sign of strong buying pressure. But probably buyers below, even if the pullback is deep. 42 tested the high close on 40 and turned down. Second entry sell. Okay to exit shorts below 42, but I suspect there's probably buyers below, and the buyers may not come in until the 40 low, though. And that's what happened. 43 outside up. Now we have a more clear wedge, 32, 37, and 40. And now we're getting another outside up bar. So the bulls seem to be getting strong bull bars, 37, 40, and 43. That increases the odds that the market may break to the upside. Plus, there's targets above this area right here, the bar 18 close, and this area here. Why is bar 18 a magnet? Because you had some bulls who will look at this as a second leg trap, and they see bar 18. They know bears sold the close of bar 18, but then they see 19 as a disappointment bar for the bears. And if the bears are disappointed after they sold the close of a bear bar like 18, those bears start to buy back shorts around the 18 close. And bulls know that, so bulls will also buy. And you can see if you bought anywhere around the 18 close, which is 3 even, the low of this bar, 3 even, you would have gotten filled on 21 and you would have gotten trapped on the way down. That makes the close of 18 a likely target to the upside. So 43, 44 consecutive bull bars. We're probably always in long, and we will probably get a measured move up. For the bulls, it's a bull breakout of a bear flag, 30 low, and the 40 high. The bulls want a measured move up, testing this area. 44, 45. Now we have 3 consecutive bull bars, always in long, probably buyers below, and we've obviously reached this target. Next target for the bulls is the 3 low, any of these lows right here. You had bulls buying the 11 low, for example, and scaling in lower. And guess what? You know, the odds are they're probably going to make money. The sell off down to 30, as strong as it was unsustainable. It's climactic. Sell climax down to bar 18, sideways, sell climax down to bar 24, sideways, and a sell climax down to bar 29. And because of that, all those reasons increase the probability that the market went too far too fast. And then the bulls took control. So you can argue it's a V bottom. You look at it and say, well, there's no major trend reversal. How can this happen? Well, when you get consecutive sell climaxes, it's major trend reversals on a smaller time frame. Buying pressure built here. We rallied, buying pressure built in here. And then we're getting a bull breakout of bear flag. So I view all of this whole thing really as a trading range. Even yesterday, it's really common to get bull breakouts of bear flags at the bottom of the range and bear breakouts of bull flags at the top of the range. Give me just 2 seconds. All right, sorry about that. Probably buy the close and going higher. Target above. Smaller bar on 46, so a sign of profit taking, but buyers below 46. High one buy on 47, but 4 consecutive bull bars, although the bodies are getting smaller, probably buyers below 46 and a second leg up. 48, another overlapping bar, so losing momentum. but I suspect the bulls are going to get a second leg up and back to the red line at the 11 low. 49, a breakout and a pullback, so some profit taking into the close. But do you really want to sell in this area? Where have the bears been able to make money? Nowhere in here. And because of that, it increases the probability that we're going to go a little bit higher. And you can see what happened on 49 or 50. Bears on 48 sold above the high of 48. They scaled in higher and they got trapped. They were disappointed on 49. So if you sold the high of 48 at 4 even and you scaled in higher at 625, you sold here at 4 even, you scaled in 2 points higher. That allowed you, it went 9 ticks above 48, allowing traders to sell and scale in. But look right here. Low, this bar went to 375, and this high was 4 even. So bears were able to sell above 48, scale in 2 points higher, and make money and exit at their original entry. That's a warning that the market start is probably going to start to go sideways. 51, a doji after a bull bar closing on its high with 50, starting to form more overlapping bars and increases the odds that the market's going to start to go sideways fairly soon. Outside down 52, but an obvious target just above the 11 low. This outside bar is kind of like the opposite of bar 25 over here. When you get a big outside bar, it increases the risk of a second leg down. And because of that, you have a lot of traders who will be disappointed. And if they're disappointed, they will look to scalp out at a new high. So to me, this puts the market back into a trading range. We can rally a lot higher, but I suspect any rally after this is going to be a leg in a trading range, kind of like this. As big as this sell off was, all the bulls who bought the 25 close and scaled in made money. As big as this bar is, I suspect the bulls who bought up here and scaled in will make money. I suspect the bears, let me back up. I suspect the bears who sell and scale in higher, they will make money. Inside bar on 53. It's you can call it a high one buy. You can call it a double bottom. Doesn't really matter. Probably going to go at least a little bit higher. And then 54, a second entry sell. For the bears, it's a second leg down after 52, but they're probably disappointed with 53 and buying below. And that's why we went outside up on 55. 55, a bull bar closing on its high. For the bears, it's 2 legs up. What about selling the close of 55 or selling the high of 52, scaling in higher? You can, but tight bull channel, that always increases the risk of selling on the way up. The market can go a lot further than you think, and it could ultimately get to the open of the day. So I think it's still a little too early to sell. 56, another consecutive bull bar. Good bar for the bulls, getting near the gap. And then 57, now we have 3 consecutive bull bars, probably by the close and going higher. But we have a buy climax, pause, another buy climax, sideways, another buy climax. You know the odds are we're going to get back down to this low, or at least get near it. It's possible this reset the count right here. So this is leg 1, pullback, leg 2, pullback, leg 3. But this is getting pretty climactic. And I would get out below any bar. 56, 58, we have follow through, and then a doji on 59. 57, notice how it's a bigger bar and then a tail, and then 58, big body and a tail above 58, and then a doji on 59. That's a sign of losing momentum, of weakening momentum. Plus, look to the left. All the bulls who bought in here and scaled in made money. 60, we have a bull bar. It's an inside bar, probably sellers above and scaling in higher. You can call it a high one, and in general, high ones and strong breakouts will pretty much. Let me back up. In general, high ones in a strong breakout phase lead to higher prices, but they often pull back first. However, when you start to get consecutive buy climaxes, you'll have more traders fading above bars for swings. And you can see what happened on 61. Bulls, they bought the close of 60. They scalped out for a few points. The high was 14.15, 14 and a half. This went to 18 even. So you can see it was a 2-point scalp. The bulls, they bought above. It's actually not true. It's a 3-point scalp. For the bulls, their entry price would be 14.5. They need the market to go to 17.5 plus one tick to allow them to get out. So the market went to 17.5 plus, excuse me, they needed the market to go to 7. Let me back up. One way when I look at counting for how far moves went, in other words, stop entries, I always add 2 ticks above the bar. So what I mean by that is I think about it like this. The high of this bar is 14.5. If you buy if you buy above the bar, your entry price is 14.75. But if the market goes 1 point higher to 15.75, you need 1 tick above your target to get filled. So that means you need 2 ticks above any bar or 2 ticks below any bar to make a profit at a minimum. So for me, 14.5, I automatically add 2 ticks, and that gives me 15 even. That way, it's easier to count how far the move went up. So if this is 15 even and this is 18 even, that tells me the bulls bought and they were able to scalp out for 3 points. If this went to, let's say, if this bar right here, if this went to 14.5 or 14, if this bar went to 17.75, that would mean it was a 12 tick trap. It would not have allowed traders to make a profit, but by going 1 tick higher, it did. But the more important thing is that means traders are scalping out. Inside bar 62, probably going to go sideways soon. Bear bar 63, but lots of buy climaxes, and you can see, look what happened on 64. Bulls bought the close of 62. Right here, 16 even. Disappointing follow through on 63. High of this bar 16 even. So you have more traders who are buying closes and getting more desperate to exit. 65, surprise, bear bar, probably going to go at least a little bit lower. 66, and we have a doji, probably buyers below, scaling in lower. But with this kind of a sell off, this is a 65. Let me back up. So a big bear bar like this, after consecutive climaxes, you will have traders buying, but they scalp out because they know there's sellers above. And you can kind of trickle down. 66, it's a bad stop entry by above, so probably sellers above. We're forming a micro channel. And then we got a surprise breakout on 68. 68 probably always in short, but it's a trend line break, which means you may get a deep pullback first before you get a second leg down. But the reality is, if a trader sells this close and scales in, they'll probably make money. But the bulls who bought the 67 low and scale in lower will probably make money as well. 69, reversal up, testing 55. Consecutive, you can argue it's parabolic wedge, 63, 65, and 69. But tight bear channel, probably sellers above 69 and at least a small second leg down. If you're a bull and you bought the 67 low, you're disappointed with 68 and 69, you'll probably look to get out around your original entry. Inside bar on 70, probably buyers below. And then we have a bull bar testing the gap at 67. What about buying the close of 70 or 7? What about buying the close of 71, betting that the market's going to reverse up and test the high of 62? I would not. It's a tight bear channel down to 69. Plus 71 is 2 legs up. We went up on 69, paused up on 70, and we're testing this breakout point. So this might be more of a sell the close bar than a buy the close bar. 72, second entry sell, even though it's a micro channel on 69. I would get out of shorts. I'd get out of longs below 72. Too much risk of a downside breakout. Plus, we have the 55 low. We have the 55 low right here. And because of that, this is a magnet. We're probably going to reach it. It's really common to get these kind of situations where you get a sell off. So the 55 low is 2.5, and this came to 3.25. So we came within 3 ticks of the 55 low. That is generally not an adequate test of the 55 low. Why is the 55 low important? because we rallied, we went sideways, we rallied sideways, and we have a third leg up. And generally, whenever you get a wedge, you often fall below the third leg. We have a wedge, bear flag, rallied, pull back, rally, pull back, rally. Generally, you fall below the third leg. Then you can see the buyers below this bar. Bar 40 was that third leg. We went under it and reversed up. 73, surprise bar, trapping any of the bulls that bought below. And 74, now we have 3 consecutive bear bars, always in short, probably going to go lower. We have obvious targets below, 42 low, 41 low, the 40 high, anywhere in here. So probably sell the close going lower. 56, huge bear bar. The bears who sold anywhere in here, they quickly, if you're a bear and you sold 75, you made 1 times your risk in minutes. That is going to lead to profit taking. Climactic bars like 75, climactic bars like 76 are what causes trading ranges. It happens all the time in trading ranges. These are all climaxes: sell climax, sideways, buy climax bar, reversal, sell climax down, reversal, sell climax, buy climax. It's sell climaxes lead to profit taking. And whenever enough traders begin to take profits very quickly after moves, it prevents the move from going anywhere. And you think about a tight trading range, that's exactly what happens. You have bears buying below bars and they start selling. You have bulls buying below bars, and they start selling as the market's going up. You have bears selling above bars and they quickly are buying back shorts as the market's going down, and it trades back and forth. In situations like this, you have traders selling all the way down, partial profit taking, and you have selling more. But once you start to get overlap, you have traders taking profits on signs of strength. Doji bar on 77. We may go a little bit lower. We've got a target below this low right here, or the high of this bar, which is the 30 high, the top of the signal bar. And we may get there, and you can see we got there on 78 and we turned up. So even the bears who sold the 30 high and scaled in made money. I'm going to talk about always in for a second because that's the most important way I think traders should trade. For always in, was it always in short on 2? I don't think so. I think the first always in trade, maybe you buy above 9, but it's low probability, especially after 8, as big of a bar as it is. Maybe you buy above 12, but not great either. What about selling below 13? Sure, you can argue 13, but the reality is if you sell below 13, you probably bought above 12 and you bought above 9. So I think it's unrealistic to assume that you might get lucky if you're trading in here and you might sell below 13 and not get chewed up in here. But if you're taking stop entries in a tight trading range, you have to expect you're going to take additional losses as well. And what do you do right there? Would you put your stop higher? Would you get stopped out there? So you can see if you're trading always in, you could just get 3 or 4 decent losses. And if you're trading with stop entries, it's really important in trading ranges not to take too many losses, because otherwise, if you buy above this bar and you get stopped out below it, and you buy above here and you get stopped out below, you buy here, you reverse the short, you get stopped out there. By the time you get a strong downside breakout and you can enter on the move, you'll be lucky to break even. I think it was probably always in short on probably this bar right here, 17. And no reason for the bears to exit. If the bears do exit above 19, they sell again below this bar right here, 20. And I think it's okay to exit above the bar, but it never triggered. And at this point, whenever I get a bar like this, for the reasons I stated, it's probably forming a trading range, and I'd get out above any bar at this point. Always in bears, they exit above 30. Aggressive bulls can buy, but it's pretty aggressive. Otherwise, they wait for 2 or 3 bull bars and they start buying. Do they exit below 34? They can, but consecutive sell climaxes, probably at least 2 legs up and probably buyers below. It's okay to exit below 40 or 38, this bar right here. But same problem, if you exit below and you get a bull bar, you got to look to buy again. What about buying above 40? Well, it didn't trigger. And this is also one of the important reasons why a lot of traders, instead of when they get a bar like 40, instead of just buying the close of the bar, they buy on a stop above the bar. Instead of buying the close of 37, they buy on a stop above 37 because it's common for to get a bear bar on the next bar. Same thing here. 25, a outside up bar, but if you bought the close, you would have gotten trapped. But if you tried to buy on a stop one tick above, you would not have gotten trapped. You can also say the same argument for trailing a stop. Rather than exiting on the close of this bar, exiting shorts, a lot of traders will put a stop one tick above the bar to stop them out of the trade. That way, taking a chance, it does not trigger. And bears, do they sell below 42? They can, but again, you've had a lot of bull bars. You had 4 consecutive bull bars, 3 consecutive bull bars, big bull bar, big bull bar. I think it's a mistake to sell below there. To me, consecutive sell climaxes, overall trading range price action over the past 2 days, this looks like a bear flag that may get a bull breakout. Plus, we had all this trading range trading over here, and that increases the risk that we have to rally back up to this area. 44 consecutive bull bars, so back to always in long. Some bulls will buy above 43, and no reason to get out. Do they get out below 52? They can, but probably going to reach this magnet. And you can see, same thing. 52 outside down, but failed to trigger. And it rallied up to the magnet. And then where do traders get out? I'd get out maybe below that bar, if not below that bar, and just exit the trade. After consecutive buy climaxes, the probability gets increasingly higher. You're going to test down to here. And then at some point, it's always in short. You can sell there. Other traders, they wait to sell pullback, or they can sell on the way down, and then they just get out. For me, if I'm trading always in and I see a sell climax and then a doji, I would get out as this bar turns up, or get out 1 or 2 points above any bar, certainly above this bull bar. As far as the reasonable stop entries today, I pretty much talked about all that. I thought 30 made a lot of sense, or you can buy 43. But other than that, and maybe 55. And as far as limit order trading all through here, above and below bars, you just have to be able to recognize when the market's turning down. And a lot of traders, when they're trading with limit orders, they're prepared to reverse their entry. So they're buying below bars, selling above bars, making money, doing really well through here. And then all of a sudden they get this and this, and as this starts to go down, a lot of those traders, they're willing to reverse to short. So if they bought, they scaled in, they're willing to reverse to short. And that's what causes 2 legs down. You have traders who are short, they start buying back shorts. Let me back up. You have traders that are long on 17, they start selling out of longs and even selling to go short. And then you get follow through. And when the market starts to pull back, but it can't really get anywhere, you have traders dumping their position on 21 and 22. Buy the close, sell the close. I thought it was sell the close on 17 and 18, sell the close 21, 22, 23. When I see a bar like 24, it's not really ideal sell the close. And that's a warning. 24 is a warning that if we break below it, we may reverse up. And that's why I thought 23 had a higher risk as it was going down. It was going to reverse up. If you remember, 25 went below 24, and it did not. What I'm getting at is if you sold the close at 24, you actually had time to get out as the bar turned up. 25 did not go down and then in 1 second go up here. It went down and started to stall, and traders started to buy back shorts, and then it started going up. Sell the close, maybe 28, but I'd be pretty quick to get out. Third leg down and probably forming a trading range. Probably buy the close 32, 33 if you can scale in. Maybe buy the close 37, but best looking bull bar, and it's a trend line break, so we're probably going to go sideways. buy the close 44.45 for a second leg, and maybe buy the close 57, 56, 57. But if you're buying up here, it's kind of the same problem as selling down here. Whenever you get a big outside down bar, you're probably going to enter a trading range fairly soon. And, maybe sell the close on one of these bars. So sell the close, maybe 74, 75. But after 76, I would just stop selling and let it go. Let me answer one or two questions. Okay, question. Would you wait for clear direction like 17 and 18 before selling? Well, that's part of, if you think about always in, if you go back on the recording and kind of listen to what I was talking about, I mentioned how it's really easy to get chewed up in here, buying and selling below bars, buying above bars, selling below bars. And a lot of traders will do the opposite. They buy below bars, they sell above bars, they buy below, they sell above. And it's really easy to get chewed up. I think, and that goes, someone was asking about, let me just pull up the question. I don't remember where the question was, but I think someone was asking about the 18, waiting for the first 6 to 12 bars before placing a trade. Let me see if I can find it as I'm talking. Anyways, I can't seem to find it. But the point I'm making is it's really important to learn to wait for clarity, because it's just really easy to get chewed up on the open, and it pretty much ruins your day. So if you take a lot of big losses, if you're trying to find clear direction in a sideways market, it doesn't make a lot of sense. There is no clarity from bars 3 to 15, and we know that. You look at bar 2, it's easy to look at bar 2 and think, oh my gosh, this is going lower, I've got to sell. But a lot of traders view bar 2 as, yeah, it's a decent size bear bar. It's probably going to get a second leg, but I don't know, it'll probably be disappointing. And that's what happened on 3. Bears sold the close at 2. They scalped out. They scalped out because they knew that bulls would buy the 2 close or more lower and scalp out. As far as someone was asking for trades, I think I sold the close at 2. And I don't remember if I sold the close at 2 or a pullback, but I sold, scaled in, and scalped out. And I think I took 1 or 2 limit order trades in there. I can't really remember. And I'm trying to think of what all I did. I believe I sold the close of 17. And then I didn't do really much through there. But I know let me look through here. I know I bought 32, and I believe I scaled in and scalped out. I bought below 34. I ended up buying a pullback here. I made a mistake. I sold above that bar, scaled in, and I reversed to long as 37 went up and bought more lower and scalped out once or twice and made up for it. And then I bought during 44 once or twice and bought once or twice in here. And that was pretty much it. And I think I bought below 62 and scalped out. So I bought the close of 63 and scalped out on 64. But that's pretty much all I took, at least what I remember. Let me look at some more questions. Okay, last question. Can you buy above bar 43 here with a 60% chance of the gap closing at the 19 low? Yeah, I think that trade's actually pretty interesting. So, for one, I thought 43 was a very interesting bar. And when you see the 18 low, you know bulls got trapped buying this low. And then you have 43. You know, if you buy above 43, and the way I look at that is if I bought above 43 and my stop's below, I'm hoping, let me get a sip of water. Your overall idea makes a lot of sense, buying above 43. The only comment I would make is yes, if you buy above 43, it's reasonable to assume you're going to get to the 18 or the 19 low. But the only comment I would make is think about 43. So think about what this is. This rally up to here, this is a bear flag. So we have a bear trend. We have sold off for a couple of legs, and we're getting a pullback. And remember, bear trends do not evolve into bull trends. Bear trends do not suddenly shift to bull trends. Bull trends do not suddenly shift to bear trends. Usually, you have a bull trend sideways. In other words, you have a bull trend, you get a pullback, and then the pullback evolves into a trading range and goes sideways. Then you get a bear breakout. You get a bear trend, and then a pullback that evolves into an overall trading range. And then eventually, you get a bull breakout of the trading range. And because of that, if you're buying above 43, it actually makes a lot of sense to think about taking maybe part off at the 18 low and going for a measured move up. That's why I have a measured move target from the 30 low to the 40 high. So as far as tomorrow, we keep trying. The bears sold off here, pulled back, sold off again, but it reversed up. And they tried to break below yesterday's low. But disappointing for the Bulls, yes. But I suspect the Bears will probably get disappointed tomorrow. And tomorrow, I think, has the potential to rally, but it'll probably be a disappointing day, and we'll probably have more sideways trading. All right, that's all the time I have. Thanks for watching, and I will talk to everybody soon.